But really excited about this year's program. We've had a lot of success in our government affairs efforts over the course of the last year. We've seen kind of three major initiatives that we've been engaged with over the course of many years come to fruition over the course of the last 12 months. We saw the CFPB's arbitration rule get the boot. We saw the CFPB's indirect lending auto guidance get the boot. And we saw the tax reform package get passed. And we're really excited today to have one of the key players in that whole process here to talk to us about the tax reform bill that passed, what some of the plans are for tax reform moving forward. Without further ado, let me turn it over to Randy Garton, who is on the House Ways and Means Committee as tax counsel. Thank you, Randy, for coming and be here.
These on? All right. Thank you, Sean. My name is Randy Garton, and as Sean pointed out, I am a tax counsel for Ways and Means Committee, and have been for about 18 months. I came on to the committee in preparation for tax reform. As you know, when after the 2016 elections, people got geared up and were excited about the possibility of tax reform. The Ways and Means Committee took it seriously. They beefed up their staff. In fact, it's the largest staff that the Ways and Means Committee has ever had with respect to tax in this last 18 months. And I think the members of the committee really needed to have that support and expertise because they were doing something that hasn't been done for 31 years, and that's tax reform. Before I get started, I just wanted to mention I really enjoyed how you guys started your meeting today, and with a prayer and a pledge of allegiance. I thought that was really great. I don't see that very often, and I just wanted to commend you guys for that. Thank you. So tax reform, yeah. So there was a lot that went on, and I'm sure that you guys are still getting up to speed with what tax reform means to your business. I'm just going to talk about some of the provisions that maybe you'd be interested in and probably already familiar with. So this might be just a review for you guys. And then I want to talk a little bit about efforts going on at IRS and Treasury on that front, and a little bit about our tax reform 2.0, which is planned to be voted on this week on the House floor, actually. So yeah, tax reform was pretty comprehensive. Had a lot of changes in both the individual space, the domestic business space, and international space. Of the three areas, the area that had probably the most change was the international space. I'm not going to touch on that very much, but it was kind of a wholesale change in approach on how federal taxes are collected in international and cross-border transactions. Going from a worldwide taxation regime to a more territorial taxation regime to follow, our other jurisdictions in the world have been doing it that way for quite a while. On the individual side, we saw rates decrease. The increase doubling of the child tax credit, and also expanding the phase-out limits. Before, I think it was about $110,000 of income before they started phasing out, and now I think it's, I believe it's $400,000 for married filing jointly. So a lot more people will be able to enjoy that credit. We've got a doubling of the standard deduction. You have the AMT for individuals. While not repealed, the exemptions were increased such that 95% of the people who are subject to AMT previous to tax reform will no longer be subject to tax reform. And I suspect there may be people in this room that were subject to AMT that won't be going forward. I know I was in the past. We also had the doubling of the exemption for what we call death taxes, estate taxes. which is pretty important to a lot of business owners. On the domestic side, first time ever, we have the 20% deduction for pass-through business income. I suspect a lot of people in here operate in pass-through business form, and so this 20% deduction is something new. It's something that everyone probably is trying to wrap their head around and understand implications and benefits it could be giving you. There are a lot of rules around that, and we can discuss a little bit of that a little bit later. Another provision is there's an interest on deductibility of, a limitation on the deductibility of interest, business interest. Now there are two important exemptions in that area. The first one is an exemption for small businesses. So small businesses, which is defined as a business with 25 million of gross receipts or less, is exempt from the limitation on interest deductibility. The other important limitation, especially for your industry, is interest on floor plan financing, which I'm sure you're all familiar with that, much more than I am, is always deductible. There's no limitation on that whatsoever, even if you're a large business or small business. So there's two important exemptions. There are others for the farming industry and regulated public utilities, but if there's a regulated public utility person in here, they're probably in the wrong area, right? So there are many more provisions, and I could go on for a long time, but I don't want to lose your interest here. So the other area I want to talk about is Treasury regulations. So the Treasury, they have their plates pretty full right now. We passed comprehensive tax reform in December last year, so it's been about 9 months. And since that time, they have been busy working on regulations to help provide guidance to taxpayers with respect to the laws we enacted. Thus far, that they've released a few regulation packages. The first one, I'm not sure if it's the first one. I believe it may be the first one, was in August this year. August, maybe the first week of August, which was with respect to the pass-through business deduction. And the regulations are in proposed form. There's a comment period that's open right now. I believe it's open for another week or two. I'm not sure exact date when comments are closed. So to the extent that your industry or individual taxpayers are interested in providing comments to the Treasury with respect to those proposed regulations, that guidance, that there's still opportunity to do so. But it covers a wide range of how the pass-through deduction works. Don't want to get into too many of the details on that front. And so if you have any questions, there's going to be a Q&A session here soon. And you're free to ask me those questions. Treasury, they're also working on regulations with respect to the interest limitation rules. I don't know the timing of those, but Treasury is trying to get these out as soon as possible. They've released regulations with respect to some of the international provisions, one that's called the GILTI regime, which you may not have heard of or even care to hear about. They've released some regulations on expensing deduction, which for the first time we've, it's not the first time, but we've increased what we call bonus depreciation to 100%, 50% to 100% for a 5-year period for all business equipment. And they've released regulations on that front explaining how that used. And for the first time, that bonus depreciation is available not only for new equipment, but also for used equipment. And that's a really big change in the regime there that Treasury has provided guidance on that front, which I believe is pretty favorable guidance. So if you've had an interest in that, you can check out those regs. So they're busy working on those. Again, they're issuing all of their regulations in proposed form, allowing taxpayers to comment on them. After the comment period, they will review and have hearings and take the input, and then generally they'll release the proposed or the regs in final form. In some instances, they may also release them again back in proposed form to get additional comments, but I think that's pretty rare when they do that. So Tax Reform 2.0, we've been spending this year at Ways and Means working on a couple things. One of those things is Tax Reform 2.0. Chairman Brady is very interested in changing the culture of Washington, so it's not every 31 years where your elected congressmen think about tax reform and how to help business on the tax front. But they want to change the culture where it's an every year thing, looking for ways to improve the tax code, help entrepreneurs like yourself start businesses and be successful on that front. So this year we've released 2.0 about 3 weeks ago. We released it, I believe, 2-3 weeks ago. Had a markup last week, I believe it was. Told me that 2 weeks ago. Time flies sometimes. And there's some important provisions in there. The first, the Tax Reform 2.0 is composed of 3 bills. The first bill is what we call permanence. As you may or may not know, you probably know, tax reform last year was passed through a reconciliation process in the Senate. What that means is that there's budget restraints on the legislation that's passed. One of those restraints is that the legislation could not affect what they call the second 10-year window of the budget, so years 11 through 20. In order to achieve that, some of the individual, or most of the individual provisions were temporary, an 8-year period in which there's lower rates, increased child tax credit, et cetera. So those provisions sunset in 2026, the end of 2026. So the first bill in 2.0 is to make those individual tax provisions permanent. And so that would include, thank you. That would include the lower rates. That would include the doubling of the standard deduction, the doubling of the child tax credit, the increased exemptions on AMT, the doubling of the exemption for death taxes. It would also include the 20% deduction on pass-through business income, which I believe is probably pretty important to you guys. So that's the first bill. The second bill is what we call the Family Savings Bill, and that covers retirement and family savings provisions. In tax reform, there were a few areas in which we didn't touch, and one of those areas was retirement and retirement plans. So the bill we've introduced does a few things. It simplifies the rules for employers so that it can set up plans for their employees. There's a few provisions that do that. There are rules to encourage employees to participate in those plans, make it easier for them to do that. And the third thing it does is it introduces a couple new concepts. The first one that I really like is what we call the USA accounts. And what that is it allows individuals to set aside every year $2,500 into a retirement account. It'll grow tax-free, but the great benefit of this is the person can retrieve those dollars anytime they want for any reason without penalty. So I think that's a great way to incentivize, especially young people, to save, because when you're young, you're trying to save for a house or go to college or do something else. You may not want to put aside money in your retirement because you cannot access that without penalty. Well, this will allow people to do that. The second thing is to expand 529 accounts in 3 ways. It will allow 529 dollars to be used to pay for apprenticeships to be used for homeschooling expenses and to be used to pay off student debt. And the last thing is what we call the new baby savings. It will allow families to access their retirement savings in the event of a new baby birth or an adoption. The third bill in Tax Reform 2.0 is what we call, it's called the American Innovation Act, and it has two modest provisions to encourage entrepreneurs. Earlier this year, the Bloomberg Most Innovative Countries report came out, and for the first time, the United States fell out of the top 10. Chairman Brady is very concerned about this, but he wants to do whatever he can with respect to taxes to encourage innovation. So the bill is what we call a down payment towards that. It's modest for now, but there'll be further efforts in the future to encourage that as well, and it does two things. The first thing is it increases the amount of startup and organizational expenses that a new business may deduct in its first year, from $10,000 to $20,000. And the other thing it does is, these are very technical rules, so I apologize in the beginning. It applies specifically to C corporations, which I'm guessing most people here don't operate in C corp form. But there are rules in the tax code today that if a C corp undergoes an ownership change, there's limits placed upon how much net operating losses or credits they can use going forward. So what this bill does is remove those limits with respect to losses and credits that are generated in the first early years of a new business. New business a lot of times needs to generate capital. They get new investors. Those new investors come in, create an ownership change, limits those losses from those early years to not be able to use in the future. So we're lifting those, making those limits not as onerous and for those new business owners. So like I said, these three provisions are going to the House floor this week, and we are hopeful and we believe that we'll see the outcome of those, and hopefully it will get passed and sent to the Senate.
What day?
Thursday and Friday. Thursday and Friday. Yeah. So if you'd like to go and in the gallery and see the vote on them, I think Thursday afternoon. I'm not sure what time on Friday. Friday morning, probably. So I'm going to open it up for questions. I may regret that later, but so if anyone has any questions about tax reform in general, or 2.0, or Treasury regulations. Looks like Sean's got one, maybe. All right.
Well, Randy, thank you very much for being here and
Yeah.
sharing your comments. And one of the things that I think the car dealer community was looking forward to was the liberalization of the use of the cash method of accounting. And while I'm not asking you to get into all the technical details, what kept us from using the cash method previously was because we all have significant inventory in our business, and we also have receivables which are treated as cash equivalents, and therefore we didn't get the benefit of the cash method. But with the change that took place, it appeared like we were going to be able to use the cash method of accounting. Unfortunately, RevProc 2018-40 just came out, and it appears that it limits the ability if you have receivables to just short-term receivables, like we can't use the cash method if we have long-term receivables like we do in the buy here, pay here business, where we sell a car and finance it. Can you comment on, is that the intent, or is there going to be further clarification? Could you comment on what the intention was of the cash method of accounting?
Yeah, absolutely. So in the beginning, I don't know how closely you paid attention to tax reform, maybe before late last year. But in 2016, the Ways and Means Committee released a blueprint for tax reform. And that blueprint did a few things that were different than what was passed through Congress. One of those things was to actually go to more of a cash flow tax, where all of your expenses would be deducted when it was paid or incurred, including inventory costs and others. It would get rid of depreciation rules going forward because you're just deducting things as you go forward. It had other aspects to it that some people didn't like. We had the border adjustability tax, which I'm sure you guys have heard or may be familiar with. And so it did a lot of things that were much more far-reaching than what was done. So our members were very like that approach. It simplified things for business. So when summer last year, when the approach was changed to unify the House, the Senate, the administration, the White House, to get them on the same page. And if you remember, probably almost a year ago today, I believe it was September 27th, the framework was released from those three parties. A lot of those aspects were dropped. But because our members liked the simplicity, especially for small business, we looked to ways to increase the amount or increase the number of businesses that could use cash accounting. So we have the small, as you point out, the small business provisions. So if your business is $25 million in gross receipts or less, the cash method is available to you. Previously, cash method wasn't available, as you point out, because you may have inventory, or you may have you may be a corporation with gross receipts over a certain amount, or you're a partnership with a partner that's a C corp. They were to remove those restrictions. The Rev Proc 2018-24, I'll have to admit, squeaked by me. I actually haven't read it. Okay. But I'm going to have to take a look at that. I'm thankful that you pointed that out so that we can take a look at that. The intent here was to provide simplicity for businesses going forward, so especially the small businesses to access cash method of accounting if they couldn't otherwise do so. So I'll have to take a look at that and see what the reasoning is and what's behind that. So I'm sorry, I apologize, I can't really address that.
No, that's fine. It's very helpful. Yeah, if you would, and then hopefully the IRS is going to clarify that, because right now the receivables that are allowing the cash method on only are up to 120 days. The Rev Proc is actually 2018-40.
Yep.
2018-40. Thank you very much for your comments.
Thank you.
Being
There are mics up in front. If anybody has any questions, feel free to walk up, and I'll kind of wander the room here. John?
Thanks, Sean. Could you elaborate on the parameters of the, let me give you an example. Let's say someone buys a truck for $50,000, and he wants to deduct it first year, 100%. Could you give us just a couple parameters on that law?
Yep, sure. So first, before anybody can deduct any costs of a truck, that truck needs to be used in a trade or business. So I'm assuming that's being used in a trade or business and not for personal use. So the parameters are pretty easy right now, where previous to tax reform, if you wanted to, a truck, I'll back up a little bit. For depreciation purposes, you usually depreciate the cost of equipment, including a truck, over the useful life of that truck. And IRS has said that is a 5-year period. So a truck is a 5-year asset. So you would depreciate that truck over 5 years. There's accelerated depreciation, and I can't remember the exact numbers, but it would be higher in the first years and tail off in the last years. It's not a straight line depreciation. Bonus depreciation came into the code in 2001, I believe, and it's been 50%, it's been 100% sometimes. It's gone away over the years. Immediately before tax reform, bonus depreciation was 100%. In order for that truck to, or sorry, 50%, it was 50%. So in order for that truck to qualify for bonus depreciation, it must have been its original use. So the taxpayer would have had to buy that truck new, right off the lot. And if he had done that, then $25,000 of that $50,000 would be deductible in the first year. The remaining $25,000 would be deductible over a 5-year period. Now, after tax reform, the bonus depreciation is increased to 100%. So when the business buys that truck for $50,000, be it either new right off the lot, or used off the lot, or used from a competitor, or from their neighbor, or wherever they buy it from, unless it's from theirself. You can't buy a truck from yourself and then depreciate it. So long as you're buying it from a third party, it could be new or used, you can deduct all $50,000 in that first year. So it's a pretty wide parameters on that. Yes, there is a sunset. So it's the 100% sunsets in 5 years. I always forget what year that, 2025. And then after that, it phases out 80, 60, 40, 20.
Is there a GVW minimum on that, if it's a truck?
A what minimum?
A gross vehicle weight minimum?
Gross vehicle weight minimum.
It was 6,000, yeah.
It was 6,000. There is, now that you guys mention it, there are some rules with respect to the trucks and vehicles. They escape me right now. I apologize for that. Yeah, so there are those rules I don't believe changed. But if it's for your business use, I don't think that there's any restrictions on that front. Check with your tax attorney or accountant.
Randy,
Yeah.
could you comment on, as I understand it, the loss carryback rules have been changed to be eliminated, that we can't carry tax losses back anymore, but we can continue to carry them forward. What was the thinking or the discussion around, you know, if you can carry it forward, why can't you carry it back? I'm trying to understand why the elimination of the tax carryback laws changed.
Yeah. So previous to tax reform, as you point out, a couple rules with respect to now operating losses. They could be carried back to 2 years, 2 previous years, to the extent that there was income there to offset. And the same rule said you can carry forward the net operating loss for a 20-year period. They also operated in conjunction with the AMT rules, where AMT rules, well, the regular rules said that when you carried them forward or backwards, you can offset 100% of your income. But then the AMT rules said that you can only offset 90% of your income. And so there was an interplay between the regular tax and the alternative minimum tax with respect to how you use those net operating losses. So under tax reform, as you pointed out correctly, that losses generated in 2018 or forward will no longer be able to be carried back, only in specific instances, very narrow circumstances, but they'll be able to be carried forward indefinitely. So we took away the 20-year limitation of the carry forward, carry back no longer. During tax reform, there's budget restraints on how much, if you're not familiar with how this works, there's the Joint Committee on Taxation that looks at legislation, helps us think of policy, helps us with drafting of the legislation. They also have a lot of economists that work for them to produce what we call a score for any legislation. So they look to say, okay, well, if we can take bonus depreciation, for example, if we increase bonus from 50% to 100, that means there's more deductions occurring in years and accelerates that depreciation, and that will decrease the amount of tax revenue by X amount of dollars. And so they do that with all the provisions that are contemplated in a bill, every bill. And you kind of add up, some provisions increase revenue, some provisions decrease revenue. And it comes up with a total score for the legislation. During the tax reform, because we're going through a reconciliation process, there were budgetary rules that allowed us to, I'll call spend federal dollars with respect to tax reform. So there were give and takes with respect to how we move forward. We had some specific goals in mind, decreasing, we wanted to decrease the tax rates, but in doing that, sometimes we have to broaden the tax base at the same time. And that's one of those provisions that was kind of a base broadener on that front. Getting to lower individual rates and the lower corporate rates was something that was very important to us, and there were some compromises that had to be made along the way.
Randy, thank you for pinch hitting. I appreciate it.
Yeah.
I got 3 questions.
Sure.
The first one is that the 20% guidelines that just came out. How do we find those so we can kind of review them and
Sure.
then how long do we have to respond?
They have been, so those guidelines, if you're not familiar, it's Code Section 199 Cap A. And if you, which will help you find what you're looking for. The Treasury released regulations on that in August of this year, maybe August, I don't know, 7th or so, sometime around there, that first week of August. And they have a 60-day comment period. So I believe that comment period is going to expire here in the next week or two. I don't have the exact date. And so if you were to go on either Treasury's website or maybe Sean knows where, I'm sure Sean has seen them. I don't want to put Sean on the spot, but he's nodding his head yes. So you might be able to bend his ear to get a copy of that. They are 200 pages or so, double-spaced. So yeah, someone like me who does a lot of the reading in that area, it was I felt like a pretty an easy read as compared to some things that Treasury releases. But if you're not too familiar with the concepts, it can be a little
Thank you.
meaty.
Question number 2 is, in the world of floor plan interest,
Yes.
is there a definition for what a floor plan financing needs
There
to
is.
look like?
There is, and I think it's in the statute itself. I don't have it off the top of my head here, but generally it's debt that's secured by inventory that are motor vehicles, and motor vehicles are what you'd think: cars, trucks, boats are actually in there as well, recreational vehicles, but they all have to be self-propelled, stuff like that. So it doesn't include like truck trailers or RVs that are towed. Yeah.
Thank you. And my last question is, did I hear you right that there are guidelines coming regarding the bonus depreciation?
Yeah, those are actually released, I believe, the same week as the 20% deduction, the 199A was. So they've been out as well for almost 2 months now, and they provide guidance with respect. Mostly, bonus has been around for quite a while. So going from 50% to 100% doesn't really change that much, other than the amount you can take that first year. the rules were kind of already in place. What's new in there's a couple things that are new in there. The ability to use bonus depreciation for used equipment is new, and there are a lot of rules around that, what it means to be used and which used equipment qualifies and what doesn't. Another thing that there was a couple of new assets that were thrown into bonus that weren't previously qualified for bonus, and that's film costs and production costs, which you guys probably aren't too concerned with. And also something called qualified improvement property. So if you were to go in and if you own a building and you refurbish the inside of your building, the construction cost for that is meant to qualify for bonus. Unfortunately, there was a glitch in the drafting, so right now it doesn't qualify, but that's a technical correction that we're working on and hope to pass soon on that front. So